Daily Fiscal Pulse, the 23rd of March, 2026. As always, this is a one-day look back on the flows, so what you're seeing here is how conditions stood into Monday's close, not real time. Before we get into the numbers, here's what's moving markets. The dominant theme right now is Iran-Middle East conflict. Headlines like US sent Iran 15-point plan to end war. Report says, Trump says in negotiations right now are setting the tone. That's the emotion driving price action. Now let's see what the actual money flows tell us. The net transfer came in at $38.8 billion. On its own, that's steady enough. But the more important shift is in the short-term trend. The 5-day flow has slowed to roughly half of what we've been seeing recently. Tax receipts were the main driver on the day at $33.7 billion. Here's where that's showing up. ES closed at 6,632, well below the 20-day moving average at 6,783. The 20-day range has been 6,966 down to 6,562. Price is telling you the same story the flows are. When you widen the lens, the change in pace becomes more obvious. The 5-day average for government spending is now running at about $5.0 billion per day. The 20-day baseline sits closer to $10.9 billion. That's a meaningful drop-off in liquidity being pushed into the system. Less cash filtering through to households, balance sheets, and ultimately into markets. Financial conditions, as a result, are tightening. Year on year, the picture reinforces the same point. Total spending so far this fiscal year is $923.7 billion, running about 20% below the same period last year. That's a sizable reduction in fiscal impulse, and it does have an impact on how much liquidity is circulating. For those positioned long ES, it's worth recognizing that the fiscal backdrop here isn't providing support. Our conditions gauge is sitting at -56. That said, context matters. We've seen this type of setup play out over 200 times historically. Despite the softer backdrop, the S&P has still averaged around plus 1.1% over the following month. It's a useful reminder that markets don't move in a straight line with liquidity. They often climb in spite of it. At the same time, leveraged funds have continued to add to long exposure, which adds another layer to the positioning dynamic. Margin debt is at the 96th percentile. That's extreme leverage. Historically, that's a contrarian warning sign, not a reason to pile in. Here's what this means in practice. With fiscal flows running below last year, the cushion isn't there to absorb shocks. When news is good, you get a grind higher. When something like the Iran-Middle East conflict escalates, the downside can accelerate because there's less government spending propping things up underneath. Looking ahead, there are a couple of key dates to keep on the radar. The 25th of March brings the SSA payment cycle, fourth Wednesday of the month, which can shift short-term flows. The 15th of April individual income tax deadline is the single largest reserve drain event of the year. So while fiscal drag is clearly present in the data, the pace of tightening may be starting to stabilize. The next move will likely come from how these scheduled flows land. That's the positioning edge for now.